Good afternoon. The steady rate of vaccination in many countries has lifted projections for global economic growth and boosted confidence significantly. However, vaccination rates have not been uniform, with many emerging and developing countries lagging behind. This uneven vaccination rollout will weigh heavily on some countries more than others, and on economic activities in sectors that are more dependent on close contact, such as travel, tourism, hospitality, and leisure. Until vaccination is widespread and populations develop sufficient immunity to cap virus transmission, it is expected that waves of infection will continue. As indicated by South Africa's public health authorities, a third wave of virus infection is probable in the near future. The International Monetary Fund's April forecast for global gross domestic product for 2021 was revised up to 6%. The SARB forecast for global growth in 2021 now also sits at 6%. For 2022, we expect 0.8%. Although policy settings in advanced economies remain accommodative, high global inflation and greater uncertainty about global interest rates has contributed to more recent financial market and capital flow volatility. This reflects persistent risk aversion, especially for emerging market economies that fail to take advantage of improved global prospects or run large macroeconomic imbalances. Following an expansion of 6.3% in the fourth quarter of 2020, the bank's forecast for South Africa's first quarter growth stands at 2.7%, which is much stronger than the contraction of 0.2% expected at the time of the March meeting. The economy is expected to grow by 4.2% in 2021. The stronger growth forecast reflects better sectoral growth performances and a more robust terms of trade in the first quarter of this year. Despite rising oil prices and a higher total import bill, commodity prices have risen to new highs, strengthening income gains to the economy. Household spending is also expected to be healthy this year, in line with less stringent lockdown restrictions and low interest rates. Getting back to pre-pandemic output levels, however, will take time. Supply responses remain muted in sectors that were hit harder by the pandemic. Investment, while stabilizing, remains constrained. GDP is expected to grow by 2.3% in 2022 and by 2.4% in 2023, little changed since the March meeting. Overall, and after upward revisions, the risks to the domestic growth outlook are assessed to be balanced. Moderate growth in household spending is expected over the forecast horizon, and global conditions are generally supportive of growth. Slow progress on vaccinations, limited energy supply, and policy uncertainty continue to pose downside risks to growth. The large current account surplus at present reflects good growth and higher prices for exports, still moderate prices for imported oil, and slowly reviving demand for imported consumer and investment goods. This surplus is expected to give way to a modest current account deficit by next year as exports slow and imports accelerate. Although financing conditions have modestly improved and fiscal risk has eased, the yield curve for rand-denominated bonds remains steep. The generally favorable global conditions and strong commodity export prices have led to the appreciation of the rand through the latter half of 2020 and into this year, moving the currency close to its long-run equilibrium level. Since the March meeting, The rand has appreciated by 4% on a trade-weighted basis. The implied starting point for the rand forecast is 14 rands 46 cents to the US dollar compared to 14 rands 96 cents at the time of the previous meeting. Headline consumer price inflation averaged 3.3% in 2020. The forecast for 2021 is slightly lower at 4.2% and is unchanged for 2022 and 2023 at 4.4 and 4.5% respectively. In 2020, core inflation also averaged 3.3%. The forecast for 2021 is lower at 3% and unchanged for 2022 and 2023 at 4% and 4.3% respectively. At a global level, a wide range of prices are accelerating, from raw materials to intermediate inputs to food, reflecting both global supply shortages and rising demand. Oil prices were revised up sharply in the previous forecast and remain unchanged, resulting in the petrol price inflation of 12.5% for 2021. Electricity prices are significantly higher at 10.6% for 2021. Going forward, a stronger exchange rate, ongoing moderation in unit labor costs, and sustained economic slack are expected to offset higher electricity and food price inflation, keeping the headline inflation forecast relatively stable. Expectations of future inflation have broadly stabilized at around 4% for 2021 and 4.2% for 2022. Market-based expectations for inflation are slightly lower for 2021 and over longer horizons. The overall risks to the inflation outlook appear to be to the upside. Housing-led services price inflation may continue to surprise to the downside. Food price inflation, already very high globally, has also been more moderate than expected in the South African market due to a stronger exchange rate and robust crop production. Domestic and global producer price inflation have been rising. Further risks could arise from higher domestic import tariffs and escalating wage demands. Despite generally low pass-through, a weaker rand could create additional upside risk to inflation alongside the ongoing risk from electricity and other administered prices. Oil prices have increased sharply this year, and while forecast to remain at current levels, are subject to increasing upside risk as recent data has shown. Compared to the March meeting, a higher growth forecast implies a small further narrowing of the output gap over the forecast period. The policy stance and repurchase rate level remains highly accommodative and will remain so even with steps taken to normalize interest rate levels in response to rising inflation. With inflation expectations remaining stable and despite inflation risk increasing, the committee still expects inflation to be contained in 2021 before rising to around the midpoint of the inflation target range in 2022 and 2023. Against this backdrop, the MPC decided to keep rates unchanged at 3.5% per annum. The decision was unanimous. The implied policy rate path of the quarterly projection model indicates an increase of 25 basis points in each of the second and fourth quarters of 2021. Monetary policy continues to be accommodative, keeping financial conditions supportive of credit demand as the economy recovers from the pandemic and associated lockdowns. The bank has ensured adequate liquidity in domestic markets and will continue to closely monitor funding markets for stress. In addition, regulatory relief provided to banks continues to support lending to households and firms. Important macroeconomic gains would be realized by achieving a stable public debt level, increasing the supply of energy, moderating administered price inflation, and keeping wage inflation low into the recovery. Such steps will enhance the effectiveness of monetary policy and its transmission to the broader economy. Economic and financial conditions are expected to remain volatile for the foreseeable future. In this uncertain environment, policy decisions will continue to be data dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on second-round effects. As usual, the repo rate projection from the QPM remains a broad policy guide, changing from meeting to meeting in response to new data and risks. This concludes the MPC statement, and as usual, we would then take questions from members of the press. Please identify yourself and the media house that you represent, and Ziyanda will then forward the questions to the panel. Ziyanda?
Thank you, Governor. So far, we've got a couple of questions from Reuters. Mfuneko. I'll read all of them. What relationship has the SARB observed between currency appreciation and the trade and current account balances? The trade surplus has continued to swell despite the rand's appreciation, likely reducing the value of commodity exports. Is there a significant pattern emerging here? And how, if at all, does it affect how the bank is thinking about rates? Will the rand strengthen if it continues eventually begin to impact export production and volumes? The second question from Funeko is, do you see current inflation increase as temporary?
Which increase?
Apologies. Do you see current inflation increase as temporary? And then the last question from Funeko, are we seeing cost push or demand pull inflation? Those are all the questions for now, Governor.
Thank you very much, Zian, and thank you very much, Mfuneko. The issue of the currency appreciation, there are many things that affect trade flows. Currency is just but one of them, and it affects the proceeds that we actually end up taking because we trade in foreign currency, and it affects what we actually end up paying if you translate that to rand. Of course, if the currency appreciates, it does make imports cheaper. But you've got to understand and try to figure out what is being driving the rand appreciation. The rand appreciation, as far as we're concerned, has been driven in the main by the fact that South Africa experienced a positive terms of trade shock, meaning that the prices of our exports rose faster than the prices of our imports. And that had meant that South Africa is able to earn the kind of export proceeds that we have been earning, whilst the import bill is contained at the same time. So a combination of what has happened to export prices and import prices and the exchange rate, they all play each other in arriving at what the trade balance is. We do state, by the way, that we have seen this big current account surplus this year, including the trade surplus, and that as the economy picks up, that we would expect that both imports for consumer goods and for investment goods will start to pick up, and thus the current account will then move to a small deficit. So besides the fact that we are these positive terms of trade shock and thus our exporters benefiting from this, we have had a rising commodity prices, and our own commodity prices rose faster than the prices of our imports, and which is why we had this this gain. What you actually then face is that as the economy picks up, this import compression that we had seen would disappear. So besides our exports rising, the current accounts and the trade balance story had been also an import compression story. As the economy opens up, we actually forecast that the current account surplus will revert to a deficit, albeit a smaller deficit. Is the inflation rise temporary or not? Hard to tell. There is a big debate amongst central banks and amongst economists as to whether this is a transitory rise in inflation. And our analysis at the moment is that it is transitory, but even as it rises, we do not expect it to rise beyond the midpoint of the inflation target range. In average terms, there might be months where it is higher than the 4.5, but for the current year and each of the next 2 years of the forecast horizon, we actually expect inflation to be close to the 4.5. And of course, if the inflation does surprise, as we said, that the risks are on the upside, we stand ready to act as appropriate to make sure that balance is restored. And then you ask whether this is a cost push or a demand pull inflation. Could be a combination of both. Demand is picking up, but we do not see any demand pressures at the moment. Inflation, not just in South Africa at the moment, but globally, is being driven by supply constraints and disruptions to the global supply chains. And this has led to a rise in inflation, not just in developing economies, but also in the advanced economies. We will continue to monitor that and see whether there is any threat of the rise in inflation becoming permanent. And if our analysis is that it is feeding into a continuous rise in inflation, we stand ready to act as appropriate.
Thank you, Governor. We've got a question from Pranisha Naidu at Bloomberg. The QPM suggested 25 basis hike in Q2 of 2021. You've just held your only scheduled meeting for this quarter. Please, can you explain this? A question from Funeko, Reuters. Are we in commodity super cycle? What are the implications for South Africa's economy? We've got a question from Hilary Joffe. She is asking, how concerned are you about a possible temper tantrum scenario that could hit the currency if the increase in US inflation is sustained and the US Fed moves on interest rates and QE sooner than expected?
Okay. Is there another one? Let's take the last one.
Okay. Another question from Pranisha. The real interest rate is now negative for the first time in more than 5 years. How much longer is the SARB likely to remain tolerant of this, and what will drive an upward move?
Thank you. I will take both of Pranisha's questions at the same time. The QPM, we have just had our quarterly meeting. we did make reference that the repo rate path that is in the QPM is just a guide. We can't outsource our decisions to a model. It is just but one input into our decision making process. In the same manner that last year, we had a situation in March and in April where the QPM suggested that there must be rate cuts later in the year. We decided to take those rate cuts earlier. And for at least 2 meetings, the QPM kept on suggesting that there are going to be rate cuts or there must be rate cuts later in the year. We took them earlier because we exercise judgment. It is our job as the MPC to exercise judgment and make those policy decisions. You get into this year, the QPM suggested rate hikes in the second quarter of this year and in the fourth quarter of this year. It is one input. Our analysis is that inflation remains contained and that the balance of risks are such that the MPC could continue to provide accommodation from a monetary policy perspective. You then asked the question about how long we could have real interest rates being negative. And I am glad you are raising that now because like I guess many analysts, you are looking at the contemporaneous inflation. You are using the inflation as we see it now. It was not the case in the past while where inflation was actually below the repo rate. Look on a forward-looking basis, you're correct that we say that inflation will average around 4.5 over the next 2 years. And if that is the case, with a policy rate of 3.5, that will tell us that interest rates are negative in real terms. You can do that to the extent that you believe that inflation is contained and that there is significant slack in the economy. There is still slack in this economy. And should this suggest that the monetary policy stance where we are at the moment having negative real interest rates is leading to an expectation of inflation going up, the MPC would act. However, if you look at the expected inflation over the next 2 to 3 years, it's within and it is in the ballpark of the 4.5, and for this year and next is actually below the 4.5%. So the stance is accommodative because we believe that inflation is contained, that there is slack in this economy, and this economy could do with some support. But should the balance of risks change, and we see that inflation is creeping up or could creep up, we stand ready to use our tools to make sure that inflation is contained. Are we in a commodity super cycle? Too early to tell. The commodity prices are going up, but part of it is a recovery from the slump that we saw as a result of the shock last year. A commodity super cycle could be a commodity super cycle if we see this persisting over a number of years. What would that mean for South Africa? Well, that would mean that we are earning a lot more of foreign exchange. It would mean that if this takes place and we continue with rising positive terms of trade, we are in a better position to deal with the challenges that we have in the South African economy. You are going to be talking of a completely different nominal GDP. You're talking about completely different tax take. which means that the fiscal risks become abate. What South Africa needs to do, though, is to learn from what happened in the previous cycle and make sure that we do not make the mistakes that had been made in the previous commodity cycle. Hillary, we concerned about the taper tantrum? No, not the taper tantrum. We are concerned about the data tantrum. Because you see, the US Fed has actually communicated so well that you do not have a repeat of 2013. The communication is anchored in a new policy framework that they had put in place, and they had been very transparent about this. But what we are, as I said, there has been a data tantrum. Every time the markets are surprised by inflation outcome or growth outcomes and so forth, they say they fear that inflation is rearing its ugly head. Well, from what I have seen across the analyst community, no one seems to think that US inflation will run away and go beyond like 2.5 or so. And with the Fed that is actually targeting average inflation over time, that means that they are not concerned at the moment with inflation going above the 2% target, because the law of averages is such that they would on average still be close to the 2%. Markets do react to all of this, and that is why we highlighted that this uncertainty will continue to underpin the volatility that we see in financial markets. And that just makes policy making difficult, which means that it is important that there is certainty of policy and certainty of whether you are adhering to your anchors. We are a flexible inflation targeter, and we have got inflation as an anchor of monetary policy, and that is what we would watch. And so whether there is a taper tantrum or a data tantrum, what we will continue to watch is what does this mean for the inflation outlook, and adjust policy as appropriate.
Thank you, Governor. A couple of questions from Lucanio from Business Day. Can your description of policy as highly accommodative and that it would remain so even if there was normalization be interpreted as a sign that you seriously considered tightening policy at this meeting? This question came up earlier, but it is, would it be accurate to say the QPM signaled 2 hikes this year, including this meeting, and that you decided to ignore it? Is it therefore accurate to say it now signals just 1 hike for 2021? Lucanio's last question, how much of a risk is a negative real interest rate to rand stability and inflation outlook? We've got a question from Pranisha at Bloomberg. What gave the SARB the confidence to raise your GDP growth forecast for 2021, especially given the resumption of rolling blackouts and a slow rollout of the COVID vaccine? Hillary is asking if you can elaborate on the statement, the last parts of the statement, about the important macroeconomic gains that would be achieved if the public debt level, electricity, and so on were stabilized. Could this enable lower interest rates? Can I just include one last one in this cycle, Governor? It's Nyeko at Economites. As the advanced economies continue to recover and grow, what are the chances that their current accommodative policy would change and become unaccommodative? Those are all for now, Gov.
Thank you very much, Zianda. Yes, we consider policy to be accommodative. And says, did we consider tightening policy at this meeting? We will always consider the adjustment of policy, whether we are tightening, loosening, or keeping it the same. There was no discussion about loosening of policy. There was a discussion about when will policy normalize, and that is the term that we are using. And when we say policy normalize, is meaning that at what point do you start to withdraw accommodation so that the policy rate converges to the neutral real interest rate. We were at one that there is no need to adjust policy at this meeting, and that even going forward, as we normalize policy, policy will remain accommodative. Even if you were to take the 2 rate hikes proposed by the QPM and build them in, policy would still be accommodative. The QPM had talked about or had built in 2 hikes, one in the second quarter and one in the fourth quarter. We didn't do anything at this meeting. That means that the 2 hikes are still on the table. We don't know when that would happen. It's a function of our assessment of the balance of risks going forward. And if you wait until the next meeting, we would definitely know. The question about the risk to the currency of the real negative real interest rate, I think that we had I had dealt with that. And growth, let's be clear. The key drivers of growth here had been the reopening of the economy, which means that we have got economic activity resuming. And this economic activity, you must not forget, it comes from a very low base. That last year we had an economic contraction of 7%. Globally, we are having the economies reopening, and we are seeing that global economic growth is rising again. South Africa is a small open economy, and as a small open economy that trades with the rest of the world, it is important that we embrace globalization and we take advantage of the resurgence of growth globally. Thirdly, is that we have seen that the resurgence of global growth had boosted commodity prices, including South African commodity prices, and South African commodity prices benefited more than our import prices. So that positive terms of trade shock is a key driver of what we actually are seeing in this growth revision. Hilary, you asked the question about the macroeconomic gains that would be had from stabilizing debt and solving the electricity constraints. On the debt side, understand that one of the key drivers of the neutral interest rate, real interest rate, is actually the country risk premium. And that country risk premium is very much driven by what is happening with the fiscal accounts of this country. And to the extent that we are stabilizing the debt and we are consolidating our fiscal accounts, that helps to bring down the country risk premium. And it brings down the country risk premium. It would be bringing down the neutral real interest rate. And what this would mean is that the cost of capital in this economy will begin to come down. And with the cost of capital coming down, that is positive for for investment. The electricity supply constraints that we had mentioned, our worry was that last year, even as the economy was opening up, we started to face electricity shortages. The economy was not booming. Last year, the economy contracted by 7%, and we still experienced electricity load shedding. Now, this year, we expect the economy to grow by some 4.2%. If we could have load shedding with an economy that is contracting by 7%, could you imagine how much load shedding we would have with an economy that is growing at 4.2%? And so the electricity supply constraint is a binding constraint to what this economy could potentially be growing at. And so when we talk of the macroeconomic gains, if those constraints are alleviated, the cost of capital comes down, investment goes up, growth rises, and guess what? An economy that is growing is the economy that creates jobs. If you look at last year, we had a contracting economy. Check what happened to the job situation. The economy shed jobs. And so let's be clear, for this economy to create jobs, this economy has to grow. Panelists, is there anybody who wants to add anything? I just want to check if I had missed something. We good? Okay.
We all good. Governor, I think this will be our last 4 questions from Pranisha Naidu at Bloomberg. South Africa, in relation to several central banks in sub-Saharan Africa and emerging markets, appears to still have significant monetary policy space. Our economy is expected to recover at a slower pace. Our vaccine rollout program is lagging behind others, and structural constraints, including electricity supply shortages, continue to dog the economy. Why then has the SARB ruled out further easing, and why are you already talking about normalizing the benchmark? Nico from Economite. As per the SARB stress testing, how resilient are banks should the COVID pandemic persist this year? I think we've got the FSR release next week. Are you concerned that the yield curve remains steep? What is driving this? This is from Funeko at Reuters. Funeko again, is your expectation of faster household spending proof that the rate cuts of 2020 are working? This is another question from Pranisha. The SARB celebrates its centenary next month. That's very soon after the economy suffered its worst contraction in 100 years. What do you think your personal contribution as governor and more broadly as the central bank should be in rebuilding the economy? Since inflation, according to your forecasts, will be well contained, is it not perhaps time to look beyond this to stimulate the economy? Those are all the questions from my side, Governor. Thank you.
Thank you. I am confused by Pranisha because the first question was a concern that we are remaining accommodative. And now her follow-up question is, why are you remaining accommodative? Which becomes interesting, but be that as it may, it says that we have got monetary policy space. We've utilized the monetary policy space. We are providing the support. We do not think that we have to provide additional. The space that the accommodation that we have provided, we think that is adequate for where the economy is at the moment. The structural constraints we have talked about that, and you asked the question, why are we ruling further rate cuts? Well, if we think that the risks to the inflation are on the upside, I guess doing rate cuts will be a reckless thing to do. Nico, the thing about the resilience of the banks, we can deal with that next week. We are doing the financial stability review. Suffice to say that the South African banks have proved to be resilient throughout this COVID shock. The yield curve, Mfuneko, this is your favorite question. You ask it at every meeting. The yield curve is steep for two important reasons. The first one is that short-term rates got cut very rapidly last year in response to the shock. That in itself will then steepen the yield curve, even if the longer end of the yield curve did nothing. But we also saw a steepening of the yield curve last year, and the only rational thing to reduce it to was that it was reflective of the state of the fiscus. And so, with concerns about the state of the fiscus and the fiscus looking to borrow long, you will have a steeper yield curve. Fortunately, what the fiscus did was to take advantage of that steepness of the yield curve and borrowed it in the short end of the yield curve, and that had actually saved government quite significantly in terms of debt service costs. So the number of things would drive the yield curve. The primary one thing for us was that this was reflective of the country risk premium. The rate cuts, I think that we did cover that. What we have seen is that there had been a benefit from the rate cuts. But let's be clear, the people who benefit immediately from the rate cuts are those with outstanding debt, because their debt service costs go down, so resources are released on their incomes, and they are able to then spend more. If you are unemployed and have no income, the rate cuts, you can only feel them indirectly. That is if economic activity resumes and you end up with a job. There is no doubt that the monetary policy stance had benefited households, and actually our analysis suggests that households benefited even more than what we have seen corporates benefit from as a result of this reduction. And the reason has been that for many corporates, the economy was under lockdown. For the households, to the extent that you had the rate cut and their debt service costs came down, they had money. They had money to spend, and then we had seen that. What been my personal contribution as we come to the centenary? Well, one of the things that you know as a governor is that you stop being personal about issues. You are now inseparable from your role as the governor. I think that today, as we look back at the history of the South African Reserve Bank, not just celebrating 100 years, but this year, South African Reserve Bank is celebrating 25 years of its independence, thanks to our constitutional dispensation. And third, this is 21 years of inflation targeting that we have actually had. And the story is actually a very, very positive one that we can look back with pride. That over the period from 2010 to 2020, inflation averaged 5%. The latest reading is 4.4%. And when we look back, we would know that we had succeeded in executing our mandate in terms of what the people of this country have tasked us with, which is to protect the value of the currency in the interest of balanced and sustainable growth. Sustainable growth can't be just about dealing with cyclical issues, which is where monetary policy comes in. Monetary policy smooths the deviations of growth around its long-term growth potential. And what we have actually seen had been that those structural factors that you had talked about constrained growth in this economy. And thus it is important that those structural constraints are addressed, dealt with quite comprehensively to lead the growth path of this economy. The South African Reserve Bank, of course, stands ready to act in the interest of balanced and sustainable growth within our mandate, which is price stability as is captured in the Constitution of the Republic of South Africa. Panelists, have I missed something? Well, anybody wants to add anything?
Governor, while the other MPC members are considering that, we one last
you said that we were taking the last bunch of questions. I was checking whether from the questions I had responded that they have got anything to add.
Okay.
Chair, if you don't mind, can I just add a point that you've made half the point, that when we cut rates in 2020, we provided what I would call mitigating effects to the economy. As you said, we enabled households to have more disposable income. We enabled firms to have more disposable income. They can keep people on board. Households can keep spending. But in March, April, May last year, the economy was collapsing, right? The economy was shrinking at a rapid pace. You were in lockdown. The real contribution of the SARB is during the recovery period. Right? By us keeping rates low, relatively low, in fact negative at the moment, for a significant amount of period of time, and we've now kept rates stable for, I think it's about a year. Right? By us keeping rates low, even as we normalize, rates are likely to remain highly accommodative. Right? That is our contribution to the recovery. You need low, predictable rates during the recovery to support economic activity, to encourage people to lend, to encourage businesses to invest. And that's the contribution of the SARB during a crisis. It's not only in those first 6 to 8 weeks of the crisis, it's the long period of recovery. And we are of the view that we are making a positive contribution to the recovery. Thanks, Chair.
Thank you. Zianda, you said those were the last questions, but it looked like somebody sneaked in.
Yes, somebody did sneak me. Oh, two people have snuck in. It is Mfuneko and Lucanyo, and those will be the absolute last ones, Governor. Mfuneko says, you spoke about standing ready to use tools of the bank should inflation turn nasty. Besides the repo rate, what other tools are you considering using? Lucanyo, if I could sneak, is DG Naidu disappointed about how the credit guarantee scheme worked out? Is its description as a failure fair? That's all. Thank you, Governor.
You know, a lot has been said about the credit guarantee scheme. Let's be clear. By the time the credit guarantee scheme was put in place, South African banks had long acted to support their clients. Everything from payment holidays to restructuring of loans and all of that. It was long done. Secondly, a comparison of the scheme to the other schemes elsewhere in the world showed that the drawdown on the scheme was actually within the benchmark of what we had seen elsewhere in the world. Thirdly, we must understand that these kinds of schemes are all temporary and they reach a termination date because they are schemes that are put in extraordinary times. They are no replacement for the normal functioning of the financial system. Fourthly, a closer look of what corporates have been doing in this environment actually shows that corporates have been repaying debt. Corporates have been winding down their deposits, they have been paying debt, which means that they preferred to use whatever cash they had rather than pile on new debt. I've got no doubt that we would need to evaluate this scheme once again, compare it with the other schemes elsewhere, in the world and do a post-mortem. The scheme is reaching the end of its design, and from there we would have to have normal functioning of the credit markets. Mfuneko's question, what other tools? The main tool that we have is actually the repo rate. Last year, when we experienced the shock and we felt that we needed to deploy all the other tools to cushion the economy against the shock, we used the regulatory tools, we used the bond purchase program to stabilize markets and so forth. All of those things were just supportive and dealing with the crisis that we had. The primary tool we have is the repo rate. The policy rate is the primary tool of monetary policy. DG Naidu, you want to say something about the loan guarantee scheme?
No, Chair, I think you've covered it. You must look at what the financial sector did in aggregate, and I think you've made that point. In aggregate, the financial sector supported the economy, supported their customers. Whether the scheme was as big as we would have liked is neither here nor there. The various parts of the financial sector response was significant and played a positive role in mitigating the effects of the crisis, Chair.
Thank you very much, Zianda. That concludes the proceedings of today. And for all the people with banking questions, we will see you at the Financial Stability Review launch next week. Otherwise, we will see you again in July at the next announcement of the next policy decision.